I'm Abby Hill, and I'm introducing today's webinar entitled Where's the Global Food Industry Heading? I'm delighted to be joined by Katie Askew, Deputy Editor of Just Food. Katie will be presenting the first of today's sessions. I'm also delighted to welcome Symphony IRI consultant Rod Street, Charlotte Ashton from Grant Thornton, and Mintel's Chris Brockman, who will be presenting their thoughts on where they think the food industry is heading. I'll now pass you on to Katie, who will begin today's webinar.
Thanks, Abby. Hello, everyone. Thank you for tuning in to our February webinar, which will examine the outlook for the food industry in 2013. In the next hour, we will present the findings of the Just Food Confidence Survey. Bringing together the opinion of food industry professionals from across the world, the survey acts as a barometer of industry's mood, provides a snapshot of industry opinion, and uncovers what issues are on your minds at the start of this year. We are joined today by a panel of expert speakers who will focus on some key areas for the food industry. Symphony IRI's Rod Street will be looking at consumer trends. Grant Thornton's Associate Director of Corporate Finance, Charlotte Ashton, will examine M&A outlook, and Mintel analyst Chris Brockman will provide an overview of some significant trends impacting emerging markets. In many ways, the results of this year's confidence survey confirm what we all recognise as the prevailing feelings about the industry and its prospects. After more than a decade of steady growth, the financial crisis plunged the world into a highly uncertain macroeconomic environment. And while the lows of previous years are seemingly behind us, today's operating environment remains shaped by rising unemployment, declining real incomes, inflationary pressures, a slowdown in GDP, and governmental austerity measures across a number of global markets. These factors combine to place consumer spending under mounting pressure. Perhaps it comes as little surprise then that the food industry professionals are somewhat less optimistic today than they were at this time last year. Year on year, there was a 9-point drop in those of you who thought the operating environment would improve during the 12 months commencing January 2012 and 2013. Interestingly, almost 39% of you thought that things would stay the same in 2013, up from 30% in 2012. Little change on a challenging year is not much to cheer about. While the bulk of food industry professionals still feel the operating environment will improve this year, the majority has eroded somewhat, dropping to 37.3% from 46.4% in 2012. It is apparent that the mature, highly competitive and saturated European market presents the food industry with the greatest cause for concern in 2013. A massive 51.7% of respondents identified Europe as the market where conditions are least likely to improve over the next 12 months. As if to confirm this prediction, last week the European Commission revealed its outlook that the 17-nation bloc will not exit recession this year and conceded that it is unlikely the region will return to growth in 2014. The Commission blamed the bleak economic outlook on a lack of lending for consumers and businesses alike and high joblessness. These factors could potentially have a knock-on impact for household budgets and food spending. But the food industry isn't just concerned with conditions in continental Europe. More than 16% of respondents flagged worries about the UK's prospects and fears that the triple-dip recession will hit the market. Meanwhile, fragile consumer confidence in the US and a mixed economic outlook in MENA markets were evident. Interestingly, food industry professionals also highlighted concerns over Asia's economic prospects, even though economies in the region have shown signs of resilience in the face of economic weakness, with buoyant domestic demand driving growth. While the food industry doesn't expect to get much better in 2013, the good news is that things are not expected to get an awful lot worse either. This sentiment is evidenced in predictions for consumer outlook. While fewer survey respondents anticipate an improved consumer confidence in 2013, fewer expect consumer sentiment to drop off further still. A growing majority of you expect the status quo to remain over the next 12 months. 2012 was a year of intense competition for the food industry. Weak consumer sentiment necessitated a strong focus on pricing and promotions. However, value also continued to mean more than cheap, and a bottleneck effect where companies at the premium and value ends of the market prosper at the expense of those occupying the middle ground was evident in a number of geographies. In order to thrive, branded food manufacturers frequently looked to drive top-line growth through brand-building initiatives. Likewise, private label manufacturers competing in an increasingly crowded space viewed product development and an appropriate quality-price-value matrix as a means to drive growth. Across the board, the campaign to cut costs and build margins remained in full swing. In 2013, these trends look set to heighten. A significant majority, 71.2% of respondents, anticipate that the competitive environment will intensify in the coming year. As competition heats up, the food industry battles over continued constricting consumer spending power. We can expect a renewed focus on price positioning. The food sector will look to deliver value through product development and marketing and will vie for position as it works to communicate the worth of its products to shoppers. So what does all this boil down to? Although the food industry has maintained a pragmatic approach to 2013, the vast majority of survey respondents expect to grow their business this year. With only 3.3% of respondents anticipating contraction, this bullish outlook suggests that the food sector remains upbeat in the face of some significant challenges. I'll now hand over to Symphony IRI's Rod Street, who will provide some insight into how this year's shopper trends can be used to fuel growth.
Yeah, I'm sorry about the delay. It's Rod here. Thanks ever so much, Ellie, for that introduction. We'll have a couple of slides with you as soon as we can. But I too was really very interested when I saw the confidence survey in looking particularly at the comparison between this year and last year. And although, as you mentioned, the views in terms of outlook and consumer confidence are actually somewhat more depressed than last year, I was quite encouraged by that. Really simply because it feels to me like people are getting used to this kind of bad news economic environment that we're in. And the responses seem to me to reflect that. They're broadly flat, but people's view in terms of the favourable outlook, 20% less people think it's going to be favourable, and things are also trending to the centre on consumer confidence. So all in all, it seems to me that bad news is the old news. And my experience in working with clients in the consumer goods sector in Europe is that that's the case. People have got used in year 6 of our, this sort of unique period of economic turbulence to the problems that we've got. Although, as comes out very clearly in the survey, people see it not just as a sort of a difficult economic environment, but they also see it as an increasingly difficult competitive environment. Much more competition, many more promotions, much tighter regulation, and continued volatility on commodity prices. Now, all this in the Just Food survey does reflect what we see in Symphony IRI. And the figures that Ellie mentioned, the European Commission pushing back recovery into the back end of 2013, reflects retail sales that fell 1.7% in the euro area last year. And we can see that same volume pressure in the markets in which we cover in Europe and in the States, where what you're looking at is grocery markets, so both food and non-food, really only going up by 1 to 3%, and that being driven very heavily by price. And when you come back to food, it's basically held its position, but in volume terms, it's broadly flat. It's fallen in Italy, it's fallen in the Netherlands. In most other places, it's been under 1% in terms of growth. And that reflects also real sense of frugality. If you had to summarise the shopper environment, I'd summarise it in the term of frugality, and we see that, oddly enough, right across the globe, not just in the markets that you might expect, say in Southern Europe and particular Greece. You're seeing it in other markets, including in Germany, where non-food dropped and food volumes were virtually flat. And we're seeing that in clients that we're working with. The volume pressure reflects this difficult economic environment that people are in, where they are expecting things to get worse. Symphony IRI's recently completed a very large shopper study across the whole of Europe, which will be published in a couple of weeks' time, talking to something like 26,000 shoppers. 40% of those respondents believe that their financial situation will worsen this coming year, not get better. And whilst food is a priority, and food is, you can see food being given a priority by people, actually they are sharply focused on value. So price and value is this new perspective that's crept in and is now entrenched in shoppers' views, and it means that they're looking at every which way to make the most of their hard-pressed food budget. And that can be looking at private label. So private label was up across Europe, pretty much everywhere other than France. Promotions have remained high, and indeed they've grown slightly. And half what little market growth there was last year in the European markets was actually on private label and driven by private label. And that reflects the average 30% price difference that you're seeing across Europe in private label versus national brands. So the shopper environment is one of a real search for value and frugality. And you can see that coming up. McKinsey recently also, in reviewing the major trends that they think are going to impact the food industry over the next 10 years, commented on the growth of this value segment. And you're beginning to see now major manufacturers rethink their approach to different categories, working out how best to address the value segment. And to do that, really by way of looking at the prospect of driving growth. And one of the things that also I picked up in the survey is that people are now beginning to find ways to drive growth in the environment that's continuing to be difficult. But that's fewer in number than last year. If you actually look at the companies who are growing faster, fewer companies have reported that they expect to grow over 10% this coming year than they did last year. Now that might just be realism, it might just be a reflection of the sample. But what is clear is that the successful businesses that are growing are doing more for less. They're not getting any more investment in exports, in R&D, in new products, or in sustainability than they were in the last survey. What they're actually doing is they're making the best of what they can, doing more for less, and from that identifying and exploiting the opportunities that they think face them. And we've seen that in our own clients. We've seen the real pressure to find growth opportunities. If you're sat in Europe, which is still a very difficult, probably the most difficult geographic area at the moment in the food industry, the pressure is to find a succession of really small steps whereby you can grow the business. And the assumption is built into the plans of most of the leading players that there isn't going to be market growth. It's got to be some way of outperforming what's there. And that means looking at where the growth is, which channels are growing, convenience sector, online, how do we make the best of the unique features of that channel? Or how do we make the best of what we can do in terms of innovation? Where do we put the money between the categories that we operate in, between the brands, and indeed even within the packaging types or the sizes? And that's been the response to hunting this hunt for value that shoppers are on, to try and target those areas of value. But I think what's most notable about that in terms of the thinking within businesses is that people have now taken on board that the world economy is not going to change. It's not going to change for quite a while. It's hopefully not going to get any worse, but equally it's not going to get any better. And companies must adjust what they're doing to actually succeed in the world as it is now. Now, to me, that pulls out a couple of implications. As I said, people are assuming that the world economy's shape is what we're experiencing now. This is how it's going to be. If you're going to succeed, you've got to succeed within this environment. And as a result, growth, as I see it in companies, is very much a mindset challenge. It's about finding where growth can be found in an environment that's going to be broadly static at best. And that needs a real corporate focus. So the pressure in the planning rounds towards the end of 2012 for 2013 was a focus on where can you get growth. And that's driving it, I'd observe, both in strategic terms and in operational terms. By which I mean in strategic terms, it's looking at channels, at geographies, at segments, at categories, and prioritising those which provide a platform for growth. But equally, it's looking at the operational ideas, it's looking at ways of streamlining the cost of product between markets in terms of standardisation, in terms of ways of looking at what's non-value add in the product that can be eliminated or reduced, and in terms of getting better efficiencies in the process in manufacturing, down the supply chain, or actually within the sales and marketing functions, and making best use of that. Within all that, what is clear is that given the current market conditions, success on the corporate side requires a tremendous degree of resilience because you're playing for the longer game. It's about growth over a number of years. It's about being able to drive that and sustain the position in the market. And, in promotions which have grown enormously across most areas of Europe and indeed the States over the last 4 or 5 years, it's about not taking the quick win by cutting prices, deep promotions, that basically you're going to have to rescind to competitors when they retaliate and just wipe value out of the category. It's going to be about the agility of the business to respond quickly to trends that it sees, and about a drive to get a real edge in the eyes of the shopper on your product and your brand. So that's a quick canter through my sort of views both on the survey and the things that we've seen since then. And I'm going to hand over now to Charlotte, who's going to take a slightly different line and focus particularly on the mergers and acquisitions area. So over to you, Charlotte.
Hi everyone. I'm having some issues being able to pull up the slides, so I'll just continue on. I'm planning to spend the next 10 minutes or so talking through our expectations for M&A in the food sector in 2013, how this correlates with the outcome of Just Food's confidence survey, and also the trends that are driving activity. For me, the clear messages emerging from the survey around M&A specifically are largely positive. They demonstrate that confidence is growing around M&A. And I suppose also that businesses are opening up to M&A as a viable means to expansion. In the survey, 45% of respondents said they were willing to use M&A as a means to grow the business. This is compared to just short of 36% in 2012. Now, looking at availability of opportunities, which is very important, 50% of the respondents to the survey expect to see more M&A opportunities in 2013. This is an increase of 6% in 2012. But I suppose what's important in kind of putting this into context is comparing this outlook to the 2012 stats. Last year, the deal volumes overall were up 17%, and the values were up 64%, based on 2011, suggesting that there are more opportunities around. A major restriction to deal volume since the downturn was misalignment between buyer and seller price expectations, and also distressed deals. Distressed deals have continued to increase. About 31% of the deals in 2012 were distressed. That's compared to 14% in 2011. So, I mean, the expectation gap is narrowing, but in reality, it's the large exceptional deals which contributed to the overall increase in value last year. So to understand the factors that we think are likely to drive M&A activity in 2013, I wanted to take a quick look back at 2012 activity. In 2012 at Grant Thornton, we conducted a research project to try and get a better feeling for the factors that were driving investor interest in the food and beverage sector. The resulting report that we issued, entitled "Where is the Smart Money Going in Food and Beverage?" set out the predictions from that survey. From this, 4 predictions stood out for me. Firstly, that private equity activity would increase. Secondly, that M&A activity would be used as a means to diversify into new products and markets. Also, that new product development would be key to future stability and growth. It's something that Rod's just touched on there. And also that emerging markets would present opportunities for growth. In January of this year, Grant Thornton again published a report to update on the 2012 report entitled "Tracking Growth in Turbulent Times." This was to understand how the predictions for 2012 compared to reality. And in summary, a lot of the experts that we surveyed were pretty accurate in their views. So starting with the increased activity from private equity. We've got some slides there. 2012 saw activity at the highest levels since the start of the downturn in 2007. There are a number of funds yet to be invested, and there's a limited number of opportunities, which is driving up competition for quality assets. It is likely that private equity investment will continue to contribute to increased M&A activity, though recent stats published within our quarterly newsletter entitled Bite Size demonstrate that investors are still driving a hard bargain. Deal values on private equity-backed acquisitions only rose slightly between quarter 3 and quarter 4 in 2012. That's just a small snapshot, obviously. Private equity look to consumer trends and then do look forward quite far to identify attractive investment opportunities. For example, dining in has increased in popularity as consumer spending has been squeezed. An increase in consumers enjoying small luxuries in the home has led to private equity appetite in products such as premium chocolate, high-end alcoholic drinks and quality health offerings. Profitable cash-generative and growing businesses will continue to attract private equity attention in 2013. So looking at a couple of examples, Langham's investment in Purity soft drinks last year demonstrated the appeal of brand extension opportunities as well as growth opportunities across a diversified customer base. There's a rumoured process underway with premium mixers brand Fever Tree, which we think is likely to end up in the hands of private equity also. Restrictions on the leveraging ability cap the returns that can be achieved by private equity. And this limits their ability to compete with cash-rich corporates, of which there are a few around, who often can take a longer-term view. There are alternative structures being used to fund acquisitions, particularly by private equity, where they're increasingly applying a mixture of asset-based lending, debt, equity, and in some cases vendor-supported financing. The recent MBO of Beyond's Port business, which is backed by Endless, is likely to have been funded in using a mixture of these types of facilities. Whilst there's undoubtedly an increase in activity from private equity, they are losing out to trade on deals due to lack of synergistic benefits, which corporates can use to justify the higher valuations. increasingly for attractive assets, we're seeing private equity being left behind by trade in some of the auction processes. So if we can just move on to the second prediction from the Smart Money survey, which is M&A as a means to diversification. 71% of the respondents to the Just Food survey expected to see the competitive environment intensify, and that's something that Katie and Rod have already touched on briefly. And more than 50% of them expect to see the promotional activity and commodity prices increase. This prediction, which is fairly consistent with the feedback we're receiving from our client base also, is likely, in our view, to lead to continued UK and Irish market consolidation. There are a number of factors which contribute to consolidation in the food sector at the moment. Firstly, the food businesses are being squeezed at both ends of the spectrum. Retailers are bearing the brunt of reduced consumer spending, and suppliers are dealing with rising commodity costs and, in some cases, exchange rate exposure. Food businesses will be looking to diversify their customer base away from retail exposure, possibly into food service, where margins can be more attractive, and also the NPD generated as a result of food service relationships can be complementary to the retail relationship. Taking control of margin and sustainability of input materials by integrating the supply chain, an example of which would be Muller's acquisition of Robert Weissman Dairies, is also another trend that we expect to see continue to filter through with the smaller players over 2013. A lot of the large corporates, not necessarily UK corporates, but with UK operations, they're increasingly moving to make global acquisitions in order to spread exposure to fluctuating exchange rates and commodity prices, as well as to rationalise their distribution networks. Companies like Greencore, Kerry, Hinds through Daniels have acquisitions ingrained in the culture of their growth, and they'll continue to stimulate M&A activity. The retail environment is also impacting on strategies of overseas corporates who are exiting certain markets, as the business is seen as unsustainable and non-core. Morrison's acquisitions of Farmer's Boy was moved to take control of the supply chain. It's likely that added further weight to Vion's decision in 2012 to exit the UK market. The meat sector specifically has experienced intense margin pressure over the last few years, driven by retailers but also consumer activity. The recent Horsemeat scandal will place further pressure on this area of the market and will lead to further consolidation as businesses struggle to bear the increased costs of regulatory tightening. So looking at new product development, 50% of the Just Food survey respondents said that their investment in new product development would remain the same in 2012 as for next year. Cash generation has been restricted for many businesses. There's often a trade-off between meeting short and long-term objectives on growth in the face of increased competition. Corporates, therefore, are looking to acquire new products and expertise rather than invest time and money in developing an unproven concept at the risk of failure. Corporates value niche offerings, innovation and R&D in a target, in addition to businesses with the capacity for overseas expansion and offering the opportunity to acquire some strong consumer brands. We saw this as an example in Symington's acquisition of Chicken Tonight and Ragu. There are a number of government support initiatives in place, including tax incentives to stimulate new product development spend, which are attractive to corporates who have the capacity to make investment. There's more information on this in our report, Tracking Growth Through Turbulent Times. So coming to the final prediction of growth in emerging markets, 2012 saw international buyer of UK and Irish business activity double, albeit from a low base, from 7% in 2011 to 14% last year. Some of the most high-profile deals being German-based Intersnacks acquisition of KP Snacks, the maker of hula hoops, China-based Bright Foods acquisition of Weetabix, following their unsuccessful bid to acquire United Biscuits in 2010, and also Japanese corporate Mizcan's acquisition of Premier Foods, Hayward Pickles, Sartons Vinegar and Branston's. This activity was driven partly by the opportunity to access UK and European markets, but more so by the continued growth of the middle class in emerging markets, which contributed to changing taste, a demand for better food hygiene standards, and high-quality Western brands. The ability to take a concept and replicate this in a local market is a key motivation for a lot of the buyers, a lot of the overseas buyers specifically that we're talking to. This was important to a client that we worked with last year, India Hospitality Corp, on their acquisition of Deli Foods, the sandwich maker supply independent retailers. Moving on to the final slide, which is our predictions for the year ahead at Grant Thornton. We expect international buyer appetite to continue to grow, not only from corporates but also from overseas private equity, especially North America and Japan. UK-based investment from private equity will also continue to see increased activity, though more with a focus on development and growth funding as a mechanism for immediate full shareholder exit. As an example, the Business Growth Fund have made a number of investments since its establishment in 2011 into businesses operating in the food sector. Their investments are generally of a minority nature and place restrictions on the amount of cash out available as a proportion of total funds invested. This is to safeguard investment to fuel future business growth. There are a growing number of funds in the market taking a more flexible approach to investment structure and anticipated returns, which will drive increased activity. A link to the various reports I've referred to throughout my presentation, along with the most recent bite-sized newsletter, is included in the last slide in my presentation, along with a link to the Optimism survey. I'll now hand over to Chris. Thank you.
Okay, good afternoon everyone. I'm going to look at the growing influence of emerging markets on the global food and drink industry and where some of the opportunities are in those emerging markets. So hopefully we'll get the slides up in a minute. Firstly, I'm going to look at some of the questions in the Just Food Confidence Survey in 2013. And one of the questions in particular around, on the second slide there, around whether companies are looking to increase their investment in growing their exports during 2013. And the results indicate that a dominant 50% of companies said that yes, they would increase their investments in growing exports. Now that's slightly down on the number in a similar question from 2012, but it's still a very significant figure, very much a positive indication that companies are looking to grow their international business, especially when you consider that only 21% of companies actively said no to that question. And as I mentioned, this really does show the importance companies attach to developing international business, especially when the domestic markets they are operating in may be depressed due to economic conditions. Also, I don't know if you can see the slides yet, but also on the third slide in the presentation there, another question that I was interested to see in the Just Food Confidence Survey was which markets companies see as offering the best opportunities in 2013. And very clearly, of the emerging markets where that question was asked, China, Brazil, Russia and India, clearly it's China that companies in particular see as offering the best opportunities. 33% of companies said in the survey that they saw China as offering the best opportunities out of all those countries. Now that is down on a similar question in the 2012 survey where it was 50%, but China is clearly still the one market that companies put above the others. Brazil and India also seen both this year and last as offering better opportunities than Russia, as this chart shows. And that's very much in line with what Mintel has been seeing in terms of our research and our analysis, and also the companies we work with. It's very much China, India and Brazil, which are very much the focus of attention at the moment. And some of the slides I'll show now are going to explore some of the opportunities in those markets. So on the next slide, we can see that when we look at global economic output, if we compare the markets, the major countries in 2010, for example, China and India were already number 2 and number 4 respectively on the global GDP ranking, with Brazil number 7. Project that forward to 2050 and both India and China will have overtaken the US as the world's largest economies. China doing that first and then India seeing more growth later on. Brazil comes into 5th place by that stage, with other markets like Indonesia and Nigeria also emerging as major areas of economic growth. Indeed, the greatest growth year on year between 2010 and 2050 is forecast to be in Nigeria at 8.5% and then India at 8%. Certainly in the next few years, it's still very much dominated by China. Moving on to the next slide. So how does this translate to spend on food and drink? Well, if we look at per capita spend within some of the key global markets, between 2005 and 2016, for example, as this chart you can see now shows you, we can see how China in particular is really taking off, approaching $500 spend on food and drink per capita annually in 2012. Now this is obviously still way below the average spend in developed markets like the UK and the US, which you can see at the top of the chart here. But clearly China, within these countries covered here, this is a selection of countries globally, China is clearly the main riser, and it's quite a strong trend. And this spend is being driven, as has been mentioned already, by the growth of the middle class in China. A rapidly growing consumer base with greater disposable incomes is really driving that spend, that per capita spend increase. And the middle class is forecast to number 314 million in 2015, which is up over 80% on 2010. So a huge level of growth. On to the next slide, we can see how connecting with this very aspirational middle class is a major opportunity for luxury brands in particular. So when we ask in our consumer research, we ask middle class consumers which luxury brands they possess. You can see on the chart on the left-hand side there, looking at some of the major luxury brands operating in the market. The figures are very high, up to 50% of consumers owning some of these brands. And they are obviously clearly rapidly expanding in the country. And food and drink brands can of course tap into this demand for luxury as well. A good example here is Häagen-Dazs, ice cream brand Häagen-Dazs, whose strategy has very much been for China to enter with very premium positioned ice cream shops, rolling these out to new cities in recent years, and maintaining a very exclusive positioning. The shops are very much destination outlets, and the prices charged are very, very high for the local consumers to bear, but they're willing to spend and trade up to that kind of exclusive positioning. Having developed this very premium image, it's only recently that the brand has started to be rolled out into retail distribution, into the supermarket channel, and taking those luxury credentials with it. So a very successful example of a brand exploiting that luxury appeal. On the next slide, we can see in Brazil, meanwhile, that alcoholic drink brands have really led the way in developing the premium segment, including the use of limited editions, as these Absolut and Smirnoff vodka examples show. At the retail level, we're seeing about 1 in 10 new launches of alcoholic drinks carrying an overt premium claim. And interestingly, exports of Scotch whisky to Brazil have boomed in recent years, as has the imported beer market. Stella Artois, for example, seeing huge growth on its positioning as a classic European, therefore automatically premium European brand. And with high-profile events such as the 2014 Football World Cup and the 2016 Olympics coming up, we can expect much more activity from premium brands in the market. It should be noted, though, that in food and drink as a whole, the development of a premium segment in Brazil is some way behind that of alcoholic drinks. Only about 2% of all food and drink launches in Brazil are positioned as premium at the moment. And if we see on the next slide, you can see very much the focus is on trading up to what we would consider quite standard offerings in the West. So Brazilian consumers, for example, are trading up from local cola brands such as Foz, which is a local Brazilian brand, to Coca-Cola, which is more than double the price. The same situation is apparent in India, where wealthier consumers are starting to switch from generic low-cost vegetable oil to the more premium olive oil, for example. But in the case of this Waitrose brand showing here, which is sold in India through a tie-up with local retailer Hypercity, it's the essential Waitrose brand being used, which is of course an economy-positioned private label range in the UK. But in India, it has a very premium price tag, equivalent to over £6 in the market, almost double what it sells for in the UK. So trading up from the very basic to the standard by Western definitions is where a lot of these markets are at the moment in terms of the food and drink offering. Moving on to the next slide, we can also see that in some of these markets we're seeing a real strong shift from commodity foodstuffs to prepared food formats, often Western-style prepared food formats. So in India, for example, prepared food growth is forecast to outpace that of commodity foods between 2013 to 2016, with average growth of almost 14% per annum. But such developments are having a negative effect on the health of some of these nations as well, with high fat, high sugar processed foods leading to a huge looming obesity crisis. India, for example, already has major issues here, with associated diseases such as diabetes becoming more prevalent. India has more diabetics globally than any other country in the world already. This will have a major impact on shaping the food industry longer term, with health and wellness trends expected to play a greater role in years to come. Another issue on the next slide is associated with rapid growth in the food sector is also China's major issue with food safety. Starting with the melamine scandal some years ago, there seems to be a new food safety scandal every month in China. The ones shown here, for example, literally in the last year or so. This has led to huge concern amongst consumers. Even a state news agency survey, for example, found that almost all consumers were concerned about food safety. The result has been that many domestic players have sought to acquire foreign brands to reassure consumers, as has been mentioned previously. So Bright Foods, for example, buying the UK's Weetabix last year. There is, of course, an opportunity also in the marketplace for Western brands that can demonstrate quality and strong reputation, and many new products are highlighting their safety credentials on pack. When there are concerns about locally produced pork products, for example, Hormel's Spam brand becomes a highly desirable, safe alternative. And on the next slide, we can see that another impact of continuing food safety scares has been a boom in the use of naturally positioned food and drink in China. So the use of the no additive preservative claim and wider natural claims on pack have mushroomed in use in new product launches, as this graph shows. Natural claims being used on a high of 14% of all food and drink product launches in 2012, for example. And that's the number one claim category in the market. Even in the basics, as the next slide shows, so here we're talking about a very basic foodstuff in China, which is instant noodles. Even here, around 3/4 of Chinese consumers now actively choose healthy noodles and try to avoid noodles with artificial ingredients. Even ingredients such as MSG are being singled out for avoidance by well over half of consumers. So this really opens up the opportunity for more value-added premium products that cater to the consumer's desire for better quality, healthier, safer food products. So just to summarize on the next slide, we can see that when we talk about markets such as Brazil, India and China, one of the appeals surrounds the emergent middle-class consumer base, who are fueling demand for more premium products, which imported brands can obviously benefit from. The safety assurance of better quality food products with provenance attached to them is already a strong pull in markets like China, but more and more wider health issues will come to dominate these markets as well and represent the opportunity area. In saying all of that, though, the power that these economies will yield in years to come means that they will set the agenda for the food and drink industry globally, and more of the top multinationals will originate from these regions. We've already seen a high level of merger and acquisition activity from Chinese companies in particular. And of course, on a wider scale, we're seeing more and more Asian and Latin American foods and flavors start to shape and increasingly influence the Western food markets as well. So more and more we're going to see rapid development in emerging markets start to really shape the food industry in the West as well. So plenty to consider in the years to come. Mintel, of course, has much more market and consumer insights to help you develop such opportunities. So if you do want to get in touch, please contact me with any requirements you have. And my details on the final slide here.
Thanks very much, Chris, Rod and Charlotte. We'll now be opening up to your question and answers. So if you have any questions, please just get in touch with us via the chat. Our first question is probably one we'll start off with Charlotte to look at, and that's, are we likely to see any more mega deals like the Hinds announcement this year? Charlotte?
Hello. Yeah, I mean, I think the Hinds deal itself was it was fairly well managed in terms of being kept off everybody's radar. So it's quite hard to predict whether something like that's going to happen again. I think that was the largest food deal in history. So you know, I suppose Intersnack's acquisition of KP and Bright's acquisition of Weetabix was in itself, I think, one of the largest international buyers in food markets. So I think, given kind of the way that the emerging markets specifically are growing, there's continued chances of those kind of large deals to continue to happen.
Okay, great. Well, we've got another question here, and this is probably one for Chris, and that's, are the BRICS becoming more competitive, and how can Western food manufacturers stand out from the competition?
Competitive to the West, I assume. Yes, obviously they are. Obviously, with huge growth locally in the local markets, there are some major players emerging locally who are going to have a bigger say in the international markets going forward. So we will expect, obviously, local Chinese companies, Brazilian companies to start to have a bigger say on the global market and the markets in the West in particular. How can Western companies stand out against those? Well, obviously, by highlighting their track record and credentials around, as I mentioned, things like product safety, food safety, provenance, reputation, tradition. It's very hard, obviously, to compete against you know, Scotch whisky, for example, where it's got a huge history behind it and provenance behind it, and it's very hard for emerging markets producers to try and compete against that kind of background. So leveraging those strengths, I think, is where Western players and brands have an advantage over emerging market players.
Does that mean that Western brands really need to focus on the premium end of emerging markets?
No, not necessarily. I think that's where a lot of the success has been had so far, and some of the major multinationals have struggled in the more mainstream markets. So, for example, you take a market like ice cream in China, where both Unilever and Nestle are active in the Chinese market, and they've come up against very strong local competition. A couple of major dairy producers in China are very active in ice cream, and they've really struggled to cater to the local interests of consumers in terms of flavour and variation of formats. So I think where companies can really ingratiate themselves with local consumers by understanding their requirements around formats and flavour, there are opportunities in the mainstream level, but most success so far has been at that kind of premium level.
Okay, moving on. Our next question is, has the horsemeat scare had a negative and lasting impact on how consumers view the food industry? Now, I suppose this might be different for developed and emerging markets. So perhaps, Rod, if you'd like to talk about the impact in Europe, maybe?
Yeah, certainly. I mean, it clearly has had a very negative impact, particularly at the value end of food products, where you're dealing, and the consumer recognises that they're dealing with a product that's being produced to a very keen price, and you have seen some dips appearing, which are quite well publicised in terms of the sales of some of these products, and conversely, a move back to products that you can identify what they are. Whether that's lasting, actually, I mean, nobody knows yet, but I think I'm probably with people that if the industry does continue to respond positively, I suspect it's not lasting for a number of reasons. One is people have a relatively short memory for these things, and two, people are very tightly pressed on budget, and the the area that's being hit hardest is probably the value end, and I suspect that as long as people start to be somewhat reassured by the actions the industry takes, they will actually move back to it. Over what time frame, I don't really know, but I suspect that you're not talking more than 12 to 18 months. So I think it's a short-term effect, as long as it's not persistent, so as long as in 6 to 9 months' time it doesn't come back into the press again.
Okay, and Chris, you mentioned that China has a national obsession with food safety. Is the horsemeat scandal doing damage to European food manufacturers' reputations in China? And do you think it'll be lasting if it is?
In terms of international reputation, I haven't seen any. We haven't run any research yet suggesting that would be the case. I think undoubtedly it will have some impact, though. It's obviously a major scandal on the scale of BSE, or certainly the biggest scandal since BSE in the meat industry, and that's obviously devastated exports from Britain, for example, completely wiped out the entire beef export industry. So I think it could have a major impact internationally. It's something which we need to see how it develops, but clearly it is looking likely it will have quite a significant impact on the reputation of meat producers in Europe in particular.
Okay. Staying in China, our next question is, China is often cited as the emerging market with greatest potential, but does the recent slowdown in GDP and increasing competition, does it still present the opportunity that it once did? Chris?
Yep. I think probably not. It has obviously become much more difficult in country to operate within. And as the question rightly says, economic growth has slowed, and many foreign players have piled into the market and struggled and had to pull out. So it's not worked for everyone, and in many cases, local companies have upped their game and forced out the Western multinational brands. But certainly of the 4 BRIC countries, China is still very much the leading candidate. Longer term, there's obviously a lot of interest in Africa and other emerging Asian countries like Indonesia, Vietnam. There's high levels of growth being seen in those countries, but they are a long way behind the situation that China is in at the moment in terms of the consumer base and their relative wealth. And also, most Western players haven't even scratched the surface with China. There are obviously dozens of major cities in China which have massive population levels the size of countries in Europe, which and most attention has been focused on obviously the mega cities, Beijing, Shanghai, and so on. But the regional provinces, the regional cities, still largely untouched by most Western players. So I think we're only scratching the surface with China, and the opportunity is huge. Yes, it's probably more difficult than many multinationals were expecting to develop, and it's less attractive because of that and because of the economic slowdown. But of the 4 BRIC countries, I think it still is out there in terms of attractiveness.
Charlotte, is M&A the primary means for Western multinational companies to enter and expand in China?
No, not necessarily. I think some of those businesses are looking at different kind of mechanisms for setting up over there. It doesn't always necessarily have to be an acquisition. There may be some JVs set up over there. I think talking about kind of how the GDP has slowed, I think what we should keep in mind is whilst it's slowed, it's still growing. So there still are opportunities over there to increase business, and a lot of multinationals still see that market as one to tap into. But no, it doesn't necessarily need to be kind of M&A as the main starting point for entering that market.
Okay, moving on, what sort of growth opportunities do you expect in UK private label, and will this change in the short to medium term? Rod?
Well, private label's been growing all over Europe over the last 12 months, really, with the exception, I think, of France from memory. And it's up, I think, as I mentioned, something like 0.5%. It's already at fantastically high levels. So if you come into the UK, you're dealing at the 40 to 50% of grocery, not just across food, but across food and drink and in the packaged goods area. So you're looking at a very well-developed market, and you're looking at increasingly concentrated and powerful retailers who are looking at ways to grow in a no-growth market. And so I do think it will, in the short and medium term, continue to grow because of the appetite for value from the shopper and the creativity of the retailers in terms of offering varieties of private label. It's not just simply the standard three-tier private label. There are different approaches to branding, there's approaches to the personality of the product, and all of those are very much in the interests of the retailer in terms of both profitability and uniqueness to enable them to compete with other chains. Plus, in certain retailers, they are still behind the curve. So, someone like Morrison's, who've obviously done things with their M Kitchen range, are running in a catch-up game, and have got quite an opportunity, and I'm sure we'll carry on to exploit that opportunity over the next 12 to 18 months to try and grow it. So I would expect it to grow, as indeed it has grown. But it has grown right across Europe. We published a survey, an analysis of private label across Europe in October, which shows just how marked the economic turbulence has helped generate this flow of shoppers into private label, and is continuing to feed it. Again, partly by price difference, but partly also just by what retailers are doing. They're doing different things, new things in private label area.
The development of the retailer brand as a brand is obviously in the interest of retailers. How can brand manufacturers defend themselves against this?
I think it is very difficult if you view it just as a head-to-head competition, because you're competing with your customer, your immediate customer. But the way that the leading brand manufacturers are addressing it is by continuing to put real investment into the categories that they're strong in. And some of the brand manufacturers have huge positions in individual categories with the technologies that are in there, and they will be able to leverage that in terms of innovation. They leverage economics in terms of the way that they continue to build on the brand that they've established. And at the same time, they work hard and need to work hard at the partnership they have with the retailer to show how having a strong branded player contributes to the growth of that retailer's position, which in many categories is an argument that you can show either through analytics or just by dint of the practice and pushing it through and seeing the impact in the category. And it's those kind of arguments which demonstrate that it's still in the retailer's interest to have not just a strong own retailer set of brands, but actually strong manufacturers' brands. And the strong brands, I think, will continue to do very well. It's those that are in a second-tier level, much more difficult position, or those that don't address the trends like ageing demographics and the opportunity that provides, the value segment and how they best address it. Those that expose their flanks on those kind of trends are going to be much more hit by the challenge of retailer brands.
Thank you. Moving on, do you expect to see... Sorry, Charlotte?
Yeah?
Oh, I'm sorry, I thought you were trying to say something. Do you expect to see other large corporates dispose non-core brands as Premier Foods have done in 2012? Charlotte?
Yes, I mean Premier Foods specifically, that was driven by the refinance and their need to recapitalise the business. So there are a number of large corporates who are in situations where they need to, or they're going to start having to look to dispose of parts of the business. either because of their funding position or because the non-core are just that, and they just don't place the focus on that part of the business. So looking at large corporates like Bakkavor as an example, that would have a number of non-core businesses or divisions within the organisation that no doubt they'll start looking to dispose of. Vion, another example, Endless recently backed the MBO of the pork business, and there's still the chicken and the red meat business to be sold off there, which is more of a distressed deal, but still it marks Vion's exit from the UK market. CSM, large bakery business based in Belgium, announced last year that they were looking to dispose of their UK-based subsidiary, which is predominantly in the bakery sector, but they went on a buy and build over the last few years, and so there's a number of opportunities there within the CSM portfolio, but it depends on whether that's the plan is to sell that off whole or to sell it off in part, as to what the opportunities are for other businesses, sort of mid-market businesses looking to make acquisitions. I think in short answer to the question, yes, we do expect to see more, and there are a number that are in process at the moment that will come to light over the course of the next year.
Thank you. Now, the next question. Smithfield is moving towards certifying pork that is Rex hormone-free for export markets. Is this a growing trend, or will US meat companies continue to try to get such SPS standards imposed by China, the EU, Russia as deemed as trade barriers? Perhaps this one for Chris?
I don't know. I can't answer that question. I would defer to one of my colleagues who specialises in the meat industry. If you like, I can get my colleague to come back to the person who's answered that question. It's not an area I would be able to venture an answer on.
Do you think that food safety issues and providing products that are certified free from various chemicals is something that's becoming increasingly important in areas like Russia?
Yeah, definitely. I mean, one of the fastest growing claims in the Russian, well, actually the fastest growing claim in the Russian food market recently has been GMO free. And it's very prevalent in the Chinese market as well. So certainly there's a growing, as well as interest in additive, preservative-free claims as well. So certainly in emerging markets like Russia and China, there's a growing awareness from consumers that they want to be looking for foods which are free from certain ingredients, primarily additives, GMO ingredients, and so on. So yeah, that's definitely a trend we're seeing strongly. Obviously, it's happened in the European markets in particular to a degree. Obviously, the UK is very advanced in that regard, but it's moving heavily into those countries as well, as consumers obviously become more educated and more informed about what goes into their food, and obviously have the growing disposable income to perhaps afford to trade up to more premium products which are free from certain nasty ingredients.
Brilliant. Well, I think that about wraps up our Q&A, so I'll hand back over to Ashley.
Okay, so I'd just like to say thank you to our presenters today, Katie Askew, Deputy Editor of Just Food, and our panel of experts, Charlotte Ashton, Rod Street and Chris Brockman, and of course to all of you who have been listening. I know we've experienced a few technical difficulties, so apologies for that, but to remind you again, an audio-visual version of the webinar will be available at just-food.com/webinars, and we'll also email you a link to view and download the full session. In addition, as a thank you for participating, we'll email you an infographic demonstrating the results of the confidence survey discussed today. So finally, I'd just like to say thank you and goodbye, and we look forward to having you again in our future Just Food webinars.